decisions. It allows legislators to finance deficits instead of facing hard choices about what spending programs to cut or taxes to raise. It allows incumbents to manipulate the budget for political gain, ramping up spending before an election in the hopes of attracting swing voters or boosting programs favored by their constituents prior to leaving office. Borrowing can be relied on excessively, since future generations that lack political voice bear the burden of the government's obligations. The heavy debts incurred by those who succumb to these temptations cause problems. The higher interest rates that are needed to place additional debt can crowd out productive investments. Doubts about the government's willingness and ability to pay can dent confidence and jeopardize financial stability. This is especially true when a government's debt is held by foreigners, who enjoy the least legal protection and are therefore inclined to liquidate their investments at the first sign of trouble, in turn causing debt prices to crash. It is especially the case when the debt is held by banks, in which case a sovereign debt crisis can quickly become a banking crisis. These issues have a long history. Borrowing by monarchs and states traces back at least 1,000 years, to the period following the fall of the Carolingian Empire, of Franks and Lombards who ruled much of Europe in the first millennium CE. From that point, Europe was divided, for geographical and political reasons, into literally hundreds of city-states and princely kingdoms. Proliferating border conflicts resulted in burgeoning offensive and defensive wars. Rulers borrowed not only to expand their territories, but to defend the realm and survive. Specialized lenders, initially Italian family-run banks, mobilized resources on an unprecedented scale and developed elaborate contracts to meet the state's financial needs. Debt served the sovereign. It enabled him to retain power. It legitimized his reign by helping him protect his subjects. Equally, debt served the lenders, who were rewarded amply, if not uniformly, for their services. Not uniformly, that is, because then, as now, things could go wrong. Sovereigns sometimes borrowed for reckless and poorly conceived military adventures, or simply to line their pockets. This failure to repay inflicted losses on their lenders, extending to bankruptcy in the case of some of those selfsame Italian banking houses. One might think that this less-than-happy experience would have spelled the end of sovereign borrowing and lending. To infer this, however, would be to underestimate the value of debt to the state and belittle the ingenuity of the lenders. As military technology became more elaborate and costly, sovereigns again turned to their lenders, borrowing even larger sums to defend themselves and their subjects. As long-distance trade gained importance, they borrowed to protect their ships and trading routes. They devised new taxes and means of collecting them as ways of mobilizing the resources to service additional debts. Lenders, for their part, developed mechanisms for protecting their interests. They gained a firmer hold on the taxes earmarked for debt service by monitoring collection and even raising those taxes directly. Banks formed syndicates, enabling them not only to lend more, but also to diversify their holdings and spread the risk. They securitized their loans and organized secondary markets on which government bonds could be traded. This permitted the sovereign's obligations to be held by a still larger population of investors and the risk to be spread even more widely. Again, things didn't always go smoothly. Defaults happened. Investors took losses, but it is revealing that this market survived, and indeed thrived, for the better part of 500 years. The 17th and 18th centuries were the period of transition to the modern age of public finance. First in England and the Netherlands, and then elsewhere, investors secured protections against arbitrary action by the sovereign. They established legislatures and parliaments, in which creditors were represented, to advise and consent to the state's fiscal policies. With checks and balances in place, interest rates came down, and borrowing became easier. Acquisition of these additional fiscal and administrative resources allowed the formation of larger territories, leading to the emergence of the modern state system. Public debt played a substantial role in the